Hey, what's up, investors? I'm Russ, your favorite welder who's passionate about passive income. So we're going to dive into why some investors aren't very fond of something that you've probably heard of, the discounted cash flow or DCF method. So this could change how you think about picking stocks, and we're going to use a new tool to find 5 undervalued dividend growth stocks. Hey, come join Ian Lopick, Ryan Williams, and Brandon Beavis, amongst others, over at Blossom, the free and fun social app where you can see my real-time trades, look at my portfolio in real time, and also get cool snazzy alerts every time I make a trade. And you can also view my watch list, so I got a link for that, and it's free in the description below. I like to think of it as if you were a baseball team owner and you have 2 players to choose from, a veteran with a solid .290 batting average, which is excellent over 7 years, or a rookie who might hit 300 or might not. Which one would you bet on? The safe bet is the veteran, right? This is exactly how smart investors think about stocks. So how does this relate to investing? I've been rereading Pulak Prasad's book, What I Learned About Investing from Darwin, and Pulak Prasad doesn't use the DCF method to value stocks. Why? Because it's all about guessing about the future. I love this quote from Curtis Jensen, the former chief investment officer of Third Avenue Management, when he once said, quote, "DCF to us is sort of like the Hubble telescope. You turn it a fraction of an inch and you're in a different galaxy." I mean, it makes sense, right? If you're trying to predict something that has never happened before, like Harrow Incorporated, ticker HROW, which I invest in, suddenly making billions when it's only made millions, you're not investing. You're speculating, right? Even Warren Buffett and Charlie Munger don't invest based on others' recommendations, and as Charlie said in the 2019 annual shareholders meeting, they've missed out on some big winners like Amazon. They don't regret it because, as Charlie said, they stick to what they know and understand, and it wasn't apparent at the time that Amazon would grow to be where it is today. So if the discounted cash flow method isn't always reliable, what can we use? Enter the funky, fresh, and new Simply Safe Dividends valuation tool to help you determine whether a stock's price is too high or too low based on its history of 5-year trailing earnings or dividends. And the tool creates an expected range of 10% above and below the 5-year average, which allows us to take an unbiased look at the stock's performance. And I love this actual example that Simply Safe Dividends shared about Chevron, ticker CVX, where during the pandemic, Chevron's stock price dropped dramatically. However, this tool would have shown that Chevron was seriously undervalued based on its 5-year trailing dividends. And of course, the one, the only Warren Buffett spotted it, and he bought Chevron when it was cheap and the price did indeed bounce back. So now we're going to use this tool and find some undervalued dividend growth stocks. Over in the world of Simply Safe Dividends.com, which does cost about $500 a year. It is a little pricey, but I like to think if you manage maybe at least $10,000, then it may be worth the cost. So I'm not an affiliate. I'm not getting any money from Simply Safe Dividends for this. So we're going to pop over to the screener and see that there's about 879 matches. So we're going to get a little bit hardcore with this by picking a dividend safety score of safe or very safe, which means a cut is very unlikely. Drops us to 434 matches. We'll do a latest dividend raise of fast, because why not? We want a fast growing dividend in this one. Gets us to 146 matches. We will do a 5-year dividend growth streak of also fast, down to 108. We'll pick a dividend growth streak of 10 plus years, because if they've got 10 years under the belt of consecutive dividend raises, I think they've shown us that they're pretty serious and committed to raising the dividend. That drops us down to 82, but we can do better. Now we'll use the undervalued tool. We'll say that we want undervalued dividend stocks, which gets us to 9. But because I'm a free cash flow nut, we'll do positive free cash flow in each of the last 10 years, and that gets us to 5. And we will sort by the least undervalued to the most undervalued. First is Amdocs, ticker DOX, which provides software and services to the telecom companies, and they make their money from software sales and support. Now, digital communication is always growing, so this is an interesting one. $10 billion large cap company with a dividend safety score of 90, very safe, safe, so unlikely a cut is going to happen. Simply Safe reaffirmed their dividend safety score on August 23rd, 2024. Some nice dividend growth going on, 13% 10-year CAGR, and they last raised that dividend 10% in February of 2024, so likely have another dividend raise coming up soon. They're currently paying $1.92 per share per year, or 0.479 cents per quarter. And here's our valuation. You can see, looking back at 20 years, when I look at this shaded area, it looks kind of like the effect a rubber band would have when the gray line, which is the stock price, goes below the shaded area. It eventually comes up, and when it goes above, it eventually comes down. So currently, we are below the shaded area, which makes it undervalued. And they have an expected price of $91 to $111 a share when the current price is $87.83. And the dividend yield is well above the historical norm. The PE is below. Now we'll zip through these kind of quick. If you want to pause the video, I'm sure you can zoom in a little bit, but their free cash flow payout ratio, very low. They can easily keep raising that dividend. Generally, free cash flow per share has been up and to the right, as well as the earnings per share. Going back 10 years, they always seem to have positive sales growth, which is nice to see that the sales total is going up and to the right, and they do buy back a lot of shares, down to 117 million outstanding. Look at this, 16% return on invested capital. A good one to look for is kind of 15%, because that shows us currently Amdocs, for every $1 invested in the business, they're making about 16 cents, which, as you can see, is really good. Simply Safe likes to see above 8, but all around they have really strong margins, and according to Simply Safe, they have very, very low debt. So Amdocs looking very interesting. Next up is a company everybody knows and understands, which is Hershey, ticker HSY. They make all kinds of snacks and chocolates, and they got pirate booty. They have a dividend safety score of 80, and in August of 2024, Simply Safe reaffirmed that score of 80 safe. 10% 20-year CAGR, which is just fantastic from such a big blue chip company. Raised that dividend 15% in February of 2024. And they've paid uninterrupted dividends for 94 years. Hershey's is hitting you with $5.48 of dividends per share per year. So we'll look at two here for Hershey's and see what it says. But based on the 5-year average price to earnings ratio, they have an expected price of $206 to $252. Remember, they're thinking about 10% above and below the average trailing 5-year price to earnings ratio. So Hershey's is well below the low end of that at $193. But if we toggle to the 5-year average dividend yield, it's even more dramatic. And again, this is just based on the dividend yield, and a big blue chip company, pretty stable dividends like them, but they have an expected price of $240 to $293. But Simply Safe prefers the PE ratio as a method for valuing Hershey. Much like Amdocs, the dividend yield is well above, and the forward PE is well below the 5-year average. That's something to keep an eye on. Their free cash flow payout ratio jumped to 76%. They like to see it below 70. I like to see it closer to 60, but 60 to 70% is a pretty good sweet spot that they'll still be able to comfortably raise that dividend and do everything they need to do to keep the business running and the lights on and the chocolate coming out of the factories. A lot of what people don't like is, you can see, since 2022, their free cash flow per share has taken a hit. Analysts expect in the next 12 months to reach a new all-time high at $9.35 of free cash flow per share. And indeed, their sales have been slowing a little bit, but they're still positive. And they very gingerly buy back shares, currently down to 205 million. And those sales back in the early teens were just barely stair-stepping up. And now we've started to ramp up a little bit more. Even though it's come down from where it was at in 2015 and 2014, still a 26% return on invested capital is just awesome. 50% return on equity. Their margins are just awesome. But there's doubt they're going to be able to keep this up, right? Because with the share price so low, the market is telling us, I don't know about that. They're still paying down debt, currently 54% net debt to capital, and they can easily cover the interest on the debt at 15.38 interest coverage ratio. And again, if you don't know what interest coverage ratio is, it's how many dollars of operating income to cover every $1 of interest expense on their debt. Currently $15.38, so they can easily cover the interest on their debt. Next up, we've got Logitech, ticker LOGI, which makes and sells computer accessories like mice and keyboards, and they make their money from selling those products. I don't know, maybe they're a good investment too, because again, like Amdocs, everything keeps going more digital. It's only getting more involved with humans and not less, right? Dividend safety score of 79 safe. They had that score reaffirmed on August 6th of 2024. Look at Logitech, 11 years of dividend growth streak and uninterrupted, 17% dividend CAGR, 10% last full year growth. Now do keep in mind that this is an annual dividend, so they only pay it one time a year, currently paying $1.37 every year. And it is a foreign company, so there may be a withholding rate on those dividends of 10 to 15%, but you might be able to claim a tax credit to offset that. Now Simply Safe prefers the 5-year average dividend yield for Logitech, so current price is $89, but the expected price, $99 to $121. But if we pop on the PE, we see they expect 86 to 105, current price 89, so it looks reasonably valued using the PE ratio, but undervalued when we switch it over to the dividend yield 5-year average. The dividend yield, a little bit above the 5-year average of 1.25, and that forward PE still below the 5-year average of 21.7. Free cash flow payout ratio of only 19%, so that has come way down because the free cash flow per share has gone way up. Funny how that works, right? Math. But it looks like they've had negative sales growth in 23 and in 24. That's not stopping them from still buying back shares, even though their total sales is not as high as it was at the high water mark in 2022. So that's something to be aware of when we're looking at Logitech. 26% return on invested capital, not quite Visa numbers, but still pretty dang good. Look at that free cash flow margin, 26%. That means 26 cents out of every dollar coming in sales, it's finding its way to the bottom line as free cash flow. And again, with free cash flow, you can do things like pay a dividend, buy back shares, reinvest in the business, or carry it as cash on the balance sheet. And according to Simply Safe, they have a clean balance sheet with no net debt. And we would always want to verify this, especially with it being a foreign company, that this is indeed true. You'd want to go to their website and look at their annual report. And in the number 4 spot, we got Robert Half Incorporated, ticker RHI, which helps companies find temporary and permanent employees, and they earn money for doing that. So given the growing need for skilled workers, this could be something to think about investing in. Good old Half of Robert gives us a dividend safety score of 80 safe, and they are a mid-cap company, so we could see mid-caps do well depending on how things go in the macroeconomic world. Now they downgraded their safety score to 80 safe on August 9th of 2024, but Simply Safe still thinks that a dividend cut is unlikely. 12% 10-year CAGR, raised that dividend 10% in February of 2024, almost a 20-year dividend growth streak for Robert Half. Their quarterly dividend is paid out every March, June, September, and December, and they pay $2.12 currently every year. Now going off the 5-year average dividend yield, expected price $84 to $102, current price $67.37. Check that one out though. If we look at the 5-year PE ratio, expected price 48 to 59, and it's currently at 67. We got a little bit of cognitive dissonance going on with Simply Safe here, but they prefer the valuation method of the 5-year average dividend yield. So okay, if we go with that, they're going to say that it may be undervalued. And there you see why. Because the dividend yield is way above the 5-year average. And also, so is the PE ratio way above the 5-year average. So that's where it's going to skew that. But if the business is growing and doing well and people are buying the heck out of it, that's going to push the PE ratio way up. So doesn't necessarily mean that it's a bad investment. And it's just one way of looking and thinking about valuation. Now their free cash flow per share dropped off to $3.51, which has pushed the free cash flow per share payout ratio up. But this one I'm not so hot on because free cash flow per share was $2.07 10 years ago, $3.51 now. But this is something that would bother me and we would need to look into. It was going way up and to the right all the way until 2023. So why did it fall off a cliff and now we're just a little bit higher than we were 10 years ago? If you're going to invest in an individual stock, these are things you have to understand and questions you have to ask and answer. Negative 12% sales growth, not very nice, but this is nice, down to 105 million shares outstanding, and revenue has kind of creeped up into the right. This isn't really something something I look for in a dividend growth stock like a Visa, because check out their total sales, slightly up, then down, then up, then down. So again, we would need to understand what's going on with the business, but they have really high return on invested capital. Remember, something over 15% is pretty darn good. And everything doesn't look too bad except for the operating margin, which is when the company deducts the cost of goods and the operating expenses by sales. So that one, we got to know what's going on, Robert Half. Why are you down here? And they may or may not have any net debt. We need to verify this. Remember, Simply Safe is good, but they're not perfect and they are a third-party site. You always want to get that information from the horse's mouth and the annual report on the company's website. Last is a company we've talked about before on the channel, Rexford Industrial Realty, ticker REXR, which owns and rents out industrial buildings in Southern California. They make money from rent, and because there's high demand for warehouse space, this could be an interesting investment idea. Dividend safety score of 81, very safe for Rexford Industrial Realty. Now it is a REIT, so remember those dividends are not qualified and you will pay your ordinary income tax on those. So we always recommend holding REITs inside of tax advantage accounts like a Roth or a self-directed IRA, which is where we hold ours. Simply Safe reaffirmed that safety score on August 1st of 2024, 22% 10-year CAGR, raised that dividend 10% in February of 24. They've grown that dividend for 10 consecutive years. That quarterly dividend is paid in JAJO, which is January, April, July, and October, JAJO, $1.67 per share. And again, Rexford pays a non-qualified dividend, which is why they say we prefer to own them in a tax-sheltered account, which again, I do. Now check out this one is going off the 5-year average price to AFFO, adjusted funds from operations, which is very similar to the price to earnings, but they are a REIT. And we get an expected price of $69 to $84, and they're currently at $50.51. Now, REITs have been on fire. We got to know why, and I don't have the answer because I didn't look into it that deep, but why is Rexford not being bought when all the other REITs are going way up? And then if we look at the 5-year dividend yield average, same story, $74 to $91 expected price, current price is $50. So Rexford has a long way to go up if it does indeed follow the history of going and snapping either down back to the shaded area or up to the shaded area. So you can see where they get these numbers from and why they're affected like that. The dividend yield is way above the 5-year average of 2.02%, currently at 3.31, and the price to adjusted funds from operations is well below the 5-year average. Again, with REITs, we look at the AFFO payout ratio. They want to see them below 90%, which is pretty standard for REITs, currently at 88, even though they were as low as 69% a few years ago, but still at a comfortable level. AFFO per share stepping up and to the right every year since 2015. They seem to be growing like gangbusters because every year they're having 20%, 30%, 40% sales growth, and the AFFO per share is also growing as well, double digits the last 12 months, 11%. For any newer investors, don't worry too much about shares outstanding increasing for REITs because this is how they're making money and growing the business. They all do it because, as we see here, that Simply Safe says, REITs depend on issuing equity to fund property acquisition since they retain little internally generated cash flow after paying dividends, and if the adjusted funds from operations per share are rising over time, the capital is increasing the firm's earning power. And as we look back, we see, yes, they're issuing more shares, but the AFFO per share keeps going up in lockstep, so the business is functioning healthily. So it's nice to see, yeah, the shares outstanding are going up, but also the total sales and the AFFO per share. Return on invested capital, usually lower for REITs, so some of these margins aren't going to be apples for apples comparison with like a Costco, a Visa, or a Hershey, from what I understand. Their net debt actually very low for a REIT, and the interest coverage ratio is very nice. So this is one that is very interesting and would require a deeper dive to understand why the market isn't loving it and they're not buying up these shares of Rexford. Hey, and remember there's a link in the description below for this handy dandy Dapper Dividends performance tracker spreadsheet where you can pop in anytime you like and see exactly how the stocks have done in the videos where we've recommended them, which is just so interesting because investing, right? It's not about following the crowd or trying to predict the impossible. And we want to make smart decisions based on solid information. And as we always say on the channel, nobody knows what's going to happen in the future. So the best thing we can do is make educated guesses. Do you know why Rexford Industrial isn't being bought by the market right now? And also, which stocks do you think are undervalued that you're buying? Share that in the comments below. If you found the video helpful, give a thumbs up and consider subscribing subscribing. And speaking of Warren Buffett, in this floating little box next to my head, I shared 7 of the best Warren Buffett dividend stocks according to short sellers. So if you click this floating little box next to my head, you'll find out which 7 they are there.